So I think this is working. Okay, so this is the beginning with regards to this particular unit, and the unit's called Foundation Studies 2. So in order to get started, you really do need to understand a couple of very basic concepts that will help you throughout this unit. And I think a good place to start is to look at the accounting process. So, and we've already covered a couple of these stages. So you should be familiar with the transaction. That's where the accounting process starts. A financial event has to occur, and that's what a transaction is, a financial event. When those transactions occur, you need proof that they've actually happened. You can't just rely on your memory. So we need documentary evidence that these transactions have occurred, and that evidence is going to be used as the basis for your record keeping. So when you have a whole pile of source documents, you really need to start looking at them and saying, okay, well, what does this all mean? To help you do that, we post that information to a journal, and there are a whole variety of journals. The only journal that we've started with is the General Journal, and it's a really good basic journal. What you do is you take the information out of the source document and you decide what record needs to be kept as a result of that transaction occurring. And generally there are at least 2 records that need to be kept. And you need to decide at that stage which one is going to be debit and which one is going to be credit. Which account will be debited, which account will be credited. And you record that information in the journal. But still, those journals don't give you the kind of information you need to be able to evaluate your performance. It's the only thing about that journal is that it breaks down your double entry component. What's debit, what's credit? To help you move forward, to help you move closer to the point where you can make some decisions, we need to know exactly what's happening with these individual records. And those individual records are kept in what's called a ledger. And that ledger, remember, is just a book of accounts, a book of records. So bank is often an account that is affected by transactions. Your bank account will increase, your bank account will decrease. So in order to know exactly how much money you've got in your bank account, the logical place to go is into that account in the ledger. Same with furniture. How much furniture do we own? How much do we owe that account's payable? So you'll find all that information in the ledger. To check that your ledger is correct, to check that your debits equal your credits, we complete a trial balance. And that's just a checking mechanism and nothing more. It's best not to proceed to the next stage of your accounting process until you know that your trial balance balances, that your debits do equal your credits. And here's where we're introduced to the concepts that we're going to be looking at for this unit. And the first concept is this concept of a balance day adjustment. And those adjustments are necessary if we are going to complete effective final reports. And the final reports that we're going to focus on for this unit are your income statement or your profit and loss statement and your balance sheets. And you'll recall right at the beginning of last term, I did give you in that Foundations booklet examples of what an income statement looks like and your balance sheets as well. Income statements include information about expenses and revenues and what the resultant profit or loss is, and your balance sheet gives you information about your assets, liabilities and owner's equity. So that's a revised account of the accounting process, and we're building in these 2 new stages here. Any questions at that point? So what we've done so far is we've gotten to the trial balance section from last term. What we're going to do now is we're going to complete these final 2 stages of the process. So let's consider a couple of assumptions, and the first one is this. If you're an accountant for a business, if you have a client, or indeed if you're a business owner, you're really not going to know what your true profit is or whether you've made a loss until you go to sell your business. Sell it to someone who wants to buy it from you and take it over, or liquidate that business. It's only at that point that you're going to know whether your business has been successful or not. Most people can't wait that amount of time. And it's not advised that you do wait that long to work out whether you've made a profit or a loss, because decisions that you make that may be contributing to a loss are going to be decisions that are going to continue. So what accountants do is they employ what's called this accounting period assumption, and what that basically implies is that the life of the business is going to be divided into particular periods of time. You kind of assume that the business is going to continue indefinitely, but for accounting purposes, in order to determine whether the business has made a profit or a loss, you need to divide that infinite time into periods. And you're probably familiar with the financial year. Most businesses will divide their life into accounting periods that span the financial year. And it's at the end of the financial year that we calculate whether the business has made a profit or a loss. You can do that more frequently. You don't have to wait the year, and again, it's not advisable that you do. Software programs mean that you can click a button and it will tell you what profit you've made. You can keep clicking that button every second, every 5 minutes, every day, and it will update what profit you're making. But formally, profit is calculated and recorded at the end of the financial year. And most of you will know that the financial year begins on the 1st of July and ends on the 30th of June. We have a lot of sales around that time, end of financial year sales, particularly car manufacturers like to have this huge sale at that time.
Why?
Okay, that's not a bad question. The question was why. The reason why they like to do that is because in order to facilitate that determination of profit or loss, one of the major things that happen at the end of the accounting period is businesses will take a check or will stock check. Well, they'll do a stock take. How much stock do they own? And that helps you do a couple of things. It helps you verify that the records are accurate and whether or not there's been any loss of stock through theft, for example. Stock takes are necessary before you calculate your profit or a loss. So that's why they tend to do sales. Let's get rid of as much stock as we can, so we have to count less. And it's basically a logistic reason. Okay. So on the 30th of June, we calculate profit and loss. So you should recall that to calculate profit and loss, we need to consider expenses and revenues. And this phrase here is really important. What revenues have we earned in the financial period? What expenses have been incurred? And that means what expenses are owing in that financial period. So you kind of know this formula, but what does that actually mean for you as accountants? Well, this is what we're going to look at here. At the end of each accounting period, what we need to do is we need to close every expense and every revenue off. So what does closing an expense off mean? It means bringing that account to zero. So what's an example of an expense that you can give me?
Wages.
Wages, and that's the example I actually have on my presentation here. Wages. At the end of the accounting period, your wages may be, now remember, this is a whole year's worth of wages. Your wages may be in the millions. Now that's the balance of the wages account. $5 million it might be debit because expenses are debited. If we need to close off expenses and revenues, what that means is we're reducing that balance to zero. So from 5 million, we've got to take that balance back down to a zero balance. And that's important. Reducing expenses to zero and reducing revenues to zero helps us to achieve two actions. The first is that it allows you to transfer the balance of that expense account out of the account and into another account. And that other account is called the profit and loss summary account. So you can't take that balance out of the account and use it until you transfer it out, and transferring it out helps you close that account. The other action it allows you to perform is to collect revenue information and expense information into that second account, and it's that account that is going to tell you whether you've made a profit or a loss. So all this information is being transferred out of the revenue and expense accounts and being dumped into this one account called the profit and loss summary account. And that account collects that information and will tell you whether you've made a profit or a loss at the end of the accounting period. So we've covered those points there. P&L summary account is kind of like a working account. It gets open for only a couple of hours. It's only opened to allow you to close off your expenses and revenues. And then it gets closed as soon as it does that. So here's an example of an account that I'm going to use to give you a practical illustration of what I've been talking about. It's a sales account. So it's the end of the accounting period. We have this account. We want to calculate whether we've made a profit or a loss. I've told you we need to close off revenues and expenses to be able to calculate profit or a loss. So here we can see that this revenue account, which is a sales account, has a $1,573 credit balance. In order to close that off, to bring that to zero, what do I have to do to that account? To bring it back, to bring it down to zero. It's a sales account. It's collecting information on how much we've sold in the accounting period. To reduce that to a zero balance, what do I have to do? Do I have to debit or credit it? John? I've got to debit it. And I've got to debit it by 1,573. So if I debit it by 1,573, here it is here, debit, that balance is now zero. That's exactly where I want that revenue account to be at the end of the accounting period. It needs to be zero. But in closing it off, I've created this new account because remember, double entry, if an account is debited, something else has to be credited, and that other account is called that profit and loss summary account. And here you can see the information transferred into it. Sales is credited in this account for 1,573. So you can see the double entry there. Debit sales to close it off, another account has to be affected, profit and loss summary account is going to be credited to allow that to happen. Now that's exactly where I want that sales account to be, because the very next day is going to be July 1. And July 1, I'm going to start selling all over again. So I start that account again, but it starts at zero. So in closing it off at the end of the accounting period, it means that next accounting period, I am only collecting sales information for that accounting period and no other period before that. So that at the end of the next accounting period, I've only got sales information in there for that 2011 accounting period. Okay, so let's have a look at this expense account. Here we have wages, which is being debited for $500. It's the end of the accounting period. I need to close it off. What account am I going to close that off to? What account will help me close that off? The profit and loss summary account. It's the account that helps you close off expenses and revenues. So what do I have to do to this account to close it off? Do I have to debit it or credit it to close it off, to bring it to zero? I've got to credit it. So in the next slide here, you can see the account closed. We credited the wages account to close it off, to bring it to zero. In order to credit that account, another account had to be debited. And there you can see the wages account being debited for $500. What you can also see here is the balance now of the P&L summary account. It's gone down to 1,073. It's still a credit balance, but it's been reduced because we've transferred the wages into it. So let's focus here for a second on the P&L summary account only. if the P&L summary account, when I've transferred all expenses and revenues to it, and this business only has one expense and one revenue, after closing all my expenses and revenues to the P&L summary account, if my P&L summary account has a credit balance, I've made a net profit. Because it means that I had more credits than debits. In this example, well, obviously, I have more revenues than expenses, and you can see that in this account. Sales were 1,573, wages were 500. More revenues than expenses, I've got a credit balance, that means I've made a net profit. On the other hand, if that were to be a debit balance at the end, it means I have made more expenses, or not more expenses, but my expenses were greater than my revenues. That means I've made a loss. So that P&L summary account, in facilitating the closure of expenses and revenues, also collects that information into itself and tells you if the business has made a profit or a loss. One final step, you should remember that the owner is the person who gets the profit and the owner is the person who suffers the loss. So once that profit has been calculated in the P&L summary account, remember it's only open for about an hour, we need to close it, just like we close expenses and revenues. It goes down to zero. What do I close that to? How do I do that? How do I close that account? It had a credit balance, I have to debit it. What account is going to allow me to do that? The capital account, because the owner is going to benefit from that profit. And there's my double entry. P&L summary is debited to close off, and it's debited with capital. But in the capital account, you can see how it is credited with 1,073, and that has the effect of increasing the capital the owner now has. So he has now she has now benefited from that profit generated from the business. So what concepts have I covered here? I've covered the accounting process ending in final reports. Before we can complete the income statements and balance sheets, we've got to effect a change in the ledger of expenses and revenues so that we close them off for the period. In closing them off for the period, it allows us to start the next period with no expenses and revenues. We don't want any record of expenses and revenues from the previous period. We need to start each period with a zero balance in expenses and revenues. I've talked to you about the accounting period assumption, how the accounting period is, the life of the business is divided into accounting periods, at the end of which profit is formally calculated. That accounting period generally ends on the 30th of June. And I've also run through with you how to close off those expenses and revenues.